What's up, everyone? It's Scotty with MoneyVest. So welcome on board for our Federal Reserve FOMC live stream. So in under 30 minutes, in about 25 minutes or so, we're going to get the entire statement and the summary of economic projections. The markets, of course, are very, very optimistic. They are pushing higher, but the question remains, are we going to see these gains continue, or are we going to see them come down as soon as the Federal Reserve releases their statement and their SEP as well? So welcome on board, everyone. David, Miss KMO, thank you so much for joining as well. And we're trying to hit some specific numbers here when it comes to likes, subscribers, and of course the votes. So thank you so much for joining. If my screen is visible, if my audio is good and the video is good, just give me a thumbs up. Just want to make sure that everything is functioning well and there are no technical difficulties. So once again, thank you so much for joining. And we are live here from Dubai, and we should be all set with the FOMC meeting here in about an hour. So in about an hour, we're going to get the press conference from Jerome Powell. And then, of course, in about less than 30 minutes, we're going to get the statement and the summary of economic projections as well. Markets, of course, doing really well. Nasdaq's up over 1.4%. We've got the S&P 500 up over 1% as well. And the Dow Jones here also pushing higher, but barely, up over only 16 basis points, with the 10-year treasuries sitting at just under 4.3%. Of course, a lot of individual stocks are pushing higher, but again, the question remains, can these gains continue for rest of the trading day, especially during, the FOMC, because so far we've seen a very nice move to the upside. Apple looking good, Tesla looking good, Nvidia looking good, all of them pushing up anywhere between 4 and 5%. Microsoft's also over $3.2 trillion in market cap now, and all on the back of very, very strong inflation numbers. But, it only takes one person to ruin the party, and that could very well be Jerome Powell. We're going to find out in about a week, about an hour here, not about a week. So again, thank you so much for joining, everyone. Simran, thank you so much for mentioning everything is looking good. David, shout out to you. Aaron, again, thanks so much for joining. We've got a poll going on right now, whether you believe Powell is going to be hawkish or dovish. Let us know in the live chat and also in the vote here. Who's predicting a rug pull here? David, I would not be surprised if we see a rug pull from Wall Street, because that's what they're known for, kind of hyping up the market after inflation, pre-FOMC, and then after the inflation numbers. Would not be surprised one bit if we actually see a sell-off after or during the FOMC. So that is also a possibility. Volatility continues to slide lower, now only trading above 12, down about 3.65%, something that we have constantly watched on the channel because it's been one of the most accurate and helpful predictors for risk and rewards in the market. And of course, we've also utilized this in our MoneyVest index as we have calculated the market's technical positioning. And right now the index is at 3.66. So the lower it gets, the better the risk reward becomes. The higher it is, the more cautious and more alert we need to be in the market. And of course, right now we are somewhat unfavorable when it comes to the overall market at the moment. So again, we've got about 20 minutes, and this right here is going to be some of the updates. So if you come over to the summary of economic projections from the last meeting, so the last time the Federal Reserve released this SEP was back in March, so March 19th and 20th. That's when we got the projection materials, and you'll notice that we actually are expecting, or the Federal Reserve has been pricing in or penciling in for 3 rate cuts. So from 5.25 percentage points down to 4.6% is what the Federal Reserve has been targeting for interest rates, and of course coming down to 3.9% and then down to 3.1% by 2026 as well. So that is again a very steep decline in interest rates. This number is going to be the most important piece of information from the Federal Reserve that comes out at 2 p.m. Eastern, because right now we already know, I think the Federal Reserve is not going to cut rates. The probability for a rate remaining unchanged is over 99%, so almost 100% probability is what the Federal Reserve is expected to do. What the market's pricing in is for nothing, basically keeping rates where they are at 5.25 and 5.5%. So the bigger piece, the bigger moving piece is going to be the federal funds rate expectations. If this number remains, let's do a quick poll. I want to hear more from people here that have joined in. What do you think is going to happen if this number goes from 4.6 to more than 4.6? What happens if this number goes higher? I want to hear from all of you in the chat. What happens if this federal funds rate for 2024 goes higher than 4.6% in the SEP when they release it? Think logically, what is likely to happen to the markets in terms of reaction if this number goes up from 4.6 to, let's say, 4.8, 4.9? What is most likely to happen with the market, with the market's expectations or market's reaction after the SEP is released? And this number, again, is going to be the main focus. That's the most important number that we are paying attention to, is the federal funds rate, more specifically for 2024. None of these numbers actually, have a lot of value. I mean, the reason being is because these are, at the end of the day, expectations, right? So change in GDP, Federal Reserve really is making a prediction here. Change in unemployment, again, the Federal Reserve is making a prediction. PCE inflation, prediction. Core PCE, once again, prediction. But the federal funds rate is not really a prediction. It's really what the Federal Reserve controls, right? This is what they control. This is what they actually dictate on a regular policy meeting standpoint, because this is really what they control. This is what they can actually make a change to. And what do you think is going to happen to the markets if this number goes up from 4.6 to, let's say, 4.7, 4.8, closer to 5%? So Alan says crash, Chirag says dump, markets will turn red. And that's exactly right. Because of what? Because that means the Federal Reserve is going back on their rate cut expectations. If this number goes higher, that means fewer rate cuts from the Federal Reserve. If it goes up to, let's say, 4.7, 4.8, that means one less rate cut is what the Federal Reserve pricing in. Because right now, we're at 5.25 and 5.5%, so 5.25 and 5.5%. Federal Reserve's expectations of 4.6 basically means that we're going to be somewhere over here, 4.5 to 4.75. Now, how many rate cuts is that going from 5.25 to 4.5? That's 1, 2, 3. Right now, the Federal Reserve's penciled in 3 rate cuts for 2024. Even the market has not even priced in 3 rate cuts. They are pricing in for 2 rate cuts. That's what the market's expectations are. So it is possible that even if this number goes up, right, from 4.6 to, let's say, 4.8, right, that's kind of aligned with the market's expectations. So it is possible. I'm not saying that it will. It is possible that even if this number goes up, the market does not see that as a negative thing, because we're already pricing in for 2 rate cuts. That's fewer than what the Federal Reserve's penciled in their most recent SEP. So I hope that makes sense, because usually what's happened is the market's been more optimistic about rate cuts than the Federal Reserve, but it's not up until recently. Now the Federal Reserve in their SEP, considering that this is from 2 months ago, has been, less market's been less optimistic than the Federal Reserve, because Federal Reserve 2 months ago penciled in 3 rate cuts. Markets right now pricing in for 2. So it's possible that even if this number goes up in their most latest SEP, markets may not see that as a negative reaction, because we're already expecting 2 rate cuts as only, right? So we're not pricing in for 3. So again, we'll find out in about 16 minutes or so. Folks, do me a favor. I would really appreciate that. If you're enjoying this live stream, just do me a couple favors. Number one, drop a like on this live stream. We've only got 18 likes. Come on, guys. We can get up to at least over 100. So drop a like if you really enjoy this live stream, and also share this. Share this in Discord, on WhatsApp, wherever it is you want to share. Let's have more people join us so we can have a more engaged discussion. We can have more people join us, take a look at the market's reaction, of course, and listen to Jerome Powell's speech as well. So do me a couple favors. Drop a like on this live stream. I would really appreciate that. And share this with members, people, family members, friends, whoever it is that may want to join us, because this is an event that doesn't really affect investors. It affects everybody. It affects everybody, because what the Federal Reserve does quite literally affects people all over the world, right? Because the United States powers over 25% of global GDP. The monetary policy of the United States is one of the strongest, if not the strongest, central bank. The Federal Reserve is the strongest central bank in the world. So their policy, their interest rate expectations, their guidance is quite literally the most effective and important event in the world, financially speaking. So make sure that you have more and more people join, get more people aware of what's going on, because it's going to affect everybody in some way or another. And more importantly, what happened this week that is actually a big pivot. I want to hear from everybody in the live chat. We've got over almost 200 people watching. I want to see who remembers what happened this week that marked a big pivot in global markets. So let's see if Kevin, David, any of you guys remember, Chirag, Alan, I want to hear what happened this week that was a huge pivot from a global market standpoint. I'll give you a hint, from a global policy standpoint, what happened this week? Was it this week or was it last week? I think it was this week, right? So what happened that shifted the global, monetary policy standpoint? Big change, big pivot this week. So let's see. Let's see who's got the answer to this question. We'll go back to going over to the numbers, and then of course we'll wait for the Federal Reserve's statement and the SEP. So statement most likely is not going to change. It's going to more or less stay the same as last time, as no change. But really, it's going to be the SEP that's going to be the most important piece. Timothy says CPI. Of course, CPI was the most important thing, but I'm talking about from a policy standpoint. Canada rate cuts, yes, so that was important, but I feel like there was a much bigger event. Song says GME. From a global monetary policy standpoint, GME, yeah, sure. That was the big event, no doubt. But no, yes, you guys got it. ECB rate cuts, European cuts, yes. So European, ECB, Christine Lagarde, cutting interest rates for the first time in 5 years, 25 basis points, one of the first global sort of big central banks to cut interest rates. And really now all eyes and ears are going to be on the Federal Reserve. Some countries starting cutting interest rates. Yes, exactly right. Because that's a big deal, right, from a monetary policy standpoint, because as they start cutting interest rates, that's a huge pivot that it's now shifting from tightening to more easing policy path for global markets. And like I said, this is the most important piece. Federal Reserve, Jerome Powell, that's really what it all comes down to because of the strength of the U.S. economy. So, we'll see. We'll see what Jerome Powell and the FOMC makes the decision. What is it going to be? Of course, for this meeting, we still expect interest rates to remain unchanged, but it's really going to be the guidance. It's really going to be the guidance and the expectations for interest rates for remainder of 2024. Yeah, so Saudi Arabia leaving the petroleum dollar agreement with the USA. That, of course, has been in the works for a long time. It's not big news, but that, of course, we have discussed. A lot of the Middle Eastern countries, a lot of, of course, Saudi Arabia have wanting to be dealing with, or at least the BRICS nations have wanting to be dealing in their own currency as opposed to the US dollar. Because of course, some geopolitical tensions between those two nations, between those countries, I should say, or organizations. And that, of course, has affected the US dollar in some way, but it's still the most dominant currency and, of course, the reserve currency of the world. So that is for a different topic because it has a lot to do with foreign exchange, more geopolitics involved. But yeah, the bigger catalyst that happened this week was the ECB cuts for the first time in 5 years, 25 basis points. So QQQs are, starting to give back on some of those gains. We're only up 1.4% as opposed to over 1.6, 1.7 earlier. We've got the S&P still up over 1%, but starting to really roll over. We started pulling back, around 1:30 p.m. We dropped a little bit over 20 basis points, pushed back higher, pulling back again. And again, individual stock-wise, we still do have Apple up almost 4.9, almost 5% here, with Tesla also pushing up over 4.6, and NVIDIA also hitting a new all-time high at over 4%. It's a very, very close tie. Why is NVIDIA market cap showing us $2.83 trillion here? Just take a quick look. Yeah, right now, what happened here? Why is it showing 2.83 trillion for NVIDIA all of a sudden? Because earlier I was checking, it was showing 3.1. Huh, that's weird. I'll have to take a look at that. Apple here, 3.33. Microsoft at 3.26. And for NVIDIA, it was showing 3.1 trillion earlier on TradingView. Now it's showing as $2.83 trillion for some reason. But anyway, so 10 more minutes. 10 more minutes, folks. We're about 122 votes here. So I hope we can get up to at least 200 votes. So make sure that you do participate. And let us know what you believe is Powell's tone going to be today. 63% right now, 2/3 of you are expecting for the Federal Reserve to be dovish, and 38% as hawkish is what the expectations are. So NVIDIA diluted at the top. I mean, $2.83 trillion. That shouldn't affect the market cap. I don't know why that's showing us as 2.83 trillion. Yeah, right now it should be 3.1. I don't know why it's showing NVIDIA 2.83 at the moment, because this should be the live market cap. 3.10 trillion is the market cap for NVIDIA. So even over here it says market cap 3.10. I don't know why in TradingView is showing us 2.83. Earlier it was 3.1, but all of a sudden it kind of knocked down to 2.83 trillion. Maybe somebody at TradingView doesn't like it. Doesn't like the fact that NVIDIA has crossed over 3 trillion. Yeah, so IBKR, NVIDIA shows 3.09. For TradingView, they're not showing that. Anyway, so 9 more minutes for the numbers to come out, the big numbers, the Powerball or the Mega Million numbers. These are quite literally the Mega Million numbers. I think this should be referred to as the lottery numbers here, because so much wealth transfer happens when FOMC releases their statement, or when the SEP comes out, that this is quite literally the most important event in the financial world. Yeah, so we can look at some stocks while we wait. If there's any companies you'd like me to go over in the next 5 minutes, happy to. But yeah, overall inflation numbers coming in very strong. Stocks pushing higher on the back of those much better than expected numbers. Our forecast, yep, 2029, $3,000 a share, caddy. So we'll see. I mean, Tesla still has a lot to execute on. It's got a lot to, deliver from a fundamental standpoint, from a price target standpoint. So I'm not going to bank on the $3,000 target from ARK in 2029. If it happens, I mean, that would be crazy. I mean, $3,000 is going to be what, 20 times the price it is today. It's just crazy. Like, who puts a 20x target on a stock? Like, on what basis though? That's going to be insane. About 15 times, because it's just, I mean, 15 times the market cap for Tesla is going to be at over 7 trillion. 7 trillion for Tesla. Like, 10 times is 5 trillion, and then 15 times is going to be closer to 7.5. Almost $8 trillion. Like, I'll have to take a look at what number one in their report, like, have they mentioned in the notes, like, what were they smoking while actually coming out with those estimates, and what the actual estimates are, because $7.5 trillion for Tesla for one company by 2029 in 5 years is insane. Even Elon said it's ambitious. Yeah, it's beyond ambitious. It's beyond ambitious. Okay, so folks, we've got 6 more minutes left. We're going to take a look at some stocks here very quickly. So starting with Lululemon. So dropping a little bit down. I think the much stronger support and the best area of demand sits for Lululemon in the 280s to down to 250s. So that right there inside this green rectangle is going to be a very strong support as it continues to come down. But I think a lot of the moat and the fundamentals remain intact for Lululemon. But I think the risk reward is going to be much, much better in the 250s here for this company. So that right there inside this green rectangle and that area of support is where Lululemon, I think, finds best opportunity for risk reward for this company. So very, very oversold, of course, on the RSI, MACD, and the L3 banker oscillator here. So watch that area of demand and that support for this company. All based on FSD. Tesla 5 years back is the basis which they were projected. Yeah, based on money supply or projected inflation for later years, that's also possible, but even 7 trillion in 5 years is a lot. Robotaxis is 600 billion in their report. Okay, that's actually quite wild, $600 billion. But the thing is that, I mean, if Tesla is able to really solve robotaxis, then yes, there is a whole market of public transportation that then they can disrupt, which again is, multiple hundreds of billions, if not trillions of dollars worth of market that they could disrupt. But they have to get a lot right in order to get it done, which I'm not saying is not possible, but it happening in 5 years is a very far-fetched expectation. It's possible, but it's not that easy to accomplish, because robotaxis will be huge, no doubt. I mean, if Teslas can drive themselves and they can act as taxis, again, autonomous vehicles for people to transport, that would be a huge game changer. But execution's key for any company. Execution's everything. Caddy still bullish on Enphase? Yeah, so absolutely. I mean, Enphase, I think long term is still got tons of potential, especially when you expect rates to come down. Right now, it's coming up to its resistance of 138. So, that's a level to keep in mind. Even though today, we're back below 138 level, something that we talked about in our previous updates and market opens here, that it's possible that intraday on the day today starts to roll over and gets sold off. So red candle on a green day is possible after the gap up. But 138 is going to be that resistance. And really, I think the company's got a lot of headwinds. It's going through a lot of changes right now, especially in 2024 when rates are higher. But eventually when rates are going to come down, that's where the potential is for Enphase to reaccelerate that growth and once again see that year-over-year increases in revenue and profitability as well. Okay, so we got about 3 minutes left, folks. I'm going to switch back over to the market. So QQQs are going to be at around 1.5% higher. S&P is up about 1%. And a lot of individual stocks, of course, very, very green. 2 more minutes left. Make sure that you do participate in the poll because the speech doesn't start for another 33 minutes. So we've got plenty of time. We're trying to get to at least over 300-400 votes here. So make sure that you do participate in the poll. And let us know what you think about Powell today, whether he's going to be hawkish or dovish. And again, the most important statement and the SEP comes out in about a couple minutes here. So hope you all are ready for the big day, big announcement, because we are, we're halfway through. We're through the halfway mark here. This is the fourth meeting for the Federal Reserve in 2024. We got 4 more to go. We're already done with 2 SEPs, including today, and then we'll have 2 more SEPs later scheduled for this year. So a couple more minutes. Hope you all are ready. Let's do this. This is literally it. This is our Super Bowl for the markets every couple months, and quite interested to see what the market's reaction is going to be. So number one thing, we open the statement, we quickly browse through it, and it's most likely going to be unchanged. So just to give you an idea, we're going to open up the statement. We're going to look at, what the support, in support of the goal committee decided to maintain or whatever the case might be. If it's the same 5.25%, 5.5%, that means the rates are unchanged. And then we're going to quickly open up the summary of economic projections, and the main number we're focusing on is the 4.6% number for the federal funds rate for 2024, if that number moves higher or lower. And that's really what's going to dictate the markets and the reaction in about a minute here. So 60 seconds and we are good to go. We'll see how the markets, they can either rip higher and have even a more bullish day, or Jerome Powell can throw water to this entire rally and, we see a bit of a rug pull. Either way, it's going to be exciting. So hope you all are ready, and let's do this. And make sure that you drop a like, subscribe, and share this live stream with other folks who may want to join as well. Let's do this. Let's do this. It's always exciting. Fed Day is always a good day, regardless of what happens. There's always volatility. There's always fun. And we'll take a look here in just about 30 seconds here. Let's do this. And then we'll tune in to the speech in about 30 minutes here. What are we thinking, folks? What are we thinking? Higher or lower? 4.6 is the number. Higher or lower? Higher or lower? Let me know in the chat. Let me know what you're thinking, higher or lower in terms of the... Okay, let's do this. It's already 2 p.m. Eastern in New York. And as soon as those numbers, there we go. So there's a statement, there's the projection materials. So unchanged, that's good. And if you come down, we are looking at 5.1. Oh my God, that's not going to be, the markets may not like that. There we go. Markets may not like that. 5.1%, folks. That's about 50 basis points. That's 2 fewer rate cuts from the Federal Reserve. And now they're only expecting one rate cut in 2024 is what the Federal Reserve is pricing in. The markets may not like that at all right now. We're starting to see a bit of a drop in the S&P and the NASDAQ. Reason being, once again, the markets do not like fewer rate cuts in 2024. That's a huge upside surprise, something that we discussed in our live stream earlier before the numbers came out. So that's a huge upside revision for the federal funds rate projection-wise across the board from 4.6 to 5.1. That's a 50 basis point upside surprise for the rest of 2024. That's 2 fewer rate cuts than what they originally planned for back in April and May. So that definitely tells us that the Federal Reserve is, so it's really been quite an interesting game. So David, are you really surprised though? Yes, and the reason is because I mentioned that going into this print, going into this SEP, the markets were 1 cut ahead of the Federal Reserve. The Federal Reserve priced in 3 rate cuts. The markets were expecting 2. Now, what the Federal Reserve did was not only match the market, but went 1 step ahead. And now they're telling the market only 1 rate cut in 2024. So really now we're back to that discrepancy where the markets are a bit more optimistic than the Federal Reserve. So that's where the disappointment or the repricing risk happens. So if you come back over to the FedWatch tool, you'll notice that the market's expectations originally were for 2 rate cuts. So going from 5.25%, 5.5%, this is where we are, down to 4.75 and 5% towards the end of this year. So by December 2024, we'd be sitting at 4.25% and 5%. That's 2 rate cuts. Now, if you take a look at what the Federal Reserve is telling us, we're at 5.25% and 5.5%, and they're telling us in 2024, we're only getting down to 5.1. So that's only 1 rate cut, not 2, not 3 as they originally priced, not 2 as what the market's pricing in, only 1. So, we're seeing some volatility. We're seeing some volatility here. Markets dropped and then quickly recovered. So again, I think Jerome Powell is going to give us some more insight, some more sort of context as to what went on with these expectations. But inflation getting revised up from 2.6 to 2.8. Headline inflation also getting revised up from 2.4 to 2.6. Unemployment staying intact. GDP staying intact. If you come over to the dot plot, a lot of members now shifting more to the upside of over 5%. So we only really nobody really. So if you compare this dot plot from the previous projection materials, it's actually quite crazy because originally we had, majority members. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 10 out of the 19 members, majority, 10 out of the 19 members were expecting for rates to be below 4.75. Okay? So majority, over 50% of the members in the FOMC were expecting rates to be below 4.75 by the end of 2024. And now we've got 3, 6, and 7 plus 4, 11. 11 members out of the 19 are now expecting interest rates to be above 5. Above 5. So that's how quickly we have now shifted for interest rate expectations. And this is exactly what I was worried about. It was like, it's going to be higher, but I just don't know how much higher. I was really expecting in the 4.8 to 4.9% range, maybe 1 fewer rate cut and kind of matching the market at 2. But then, they matched the market and then they raised the market with another rate cut for another fewer rate cut and again, just only 1 rate cut being priced in. So yeah, this is going to create some volatility. I think the market's still taking some time to evaluate and adjust. We did see that initial drop as expected. Then the markets got bought up here. And we're now starting to see the real move that's going to take place, which is possible that we do see the markets roll over. Going to be very honest, this is not exactly what the markets wanted to see because we're really now getting into that sort of level where it's possible that we may not even see any rate cuts. However, though, one more thing I want to mention. What's the silver lining here? Let me see if anybody can guess the silver lining in this data that I mentioned in my yesterday's market update. So, we've got over 400 people watching. I can easily guess there's one person out there that can guess the silver lining in this data that we just received for the federal funds rate expectations for 2024. What's the silver lining here? Even though we got a huge upside surprise, what's the silver lining? I'll give you a hint. It happened today. So what's the silver lining from the data that we just got And again, I want to see more participation, more engagement in the live chat. So make sure that you do join. And of course, let me know what you think is a silver lining from the data that we just received from the S&P. So 5.1%, again, a huge upside surprise of about 50 basis points, so 2 fewer rate cuts. So Chirag says 4 cuts next year. So that is something, but that is a silver lining. So that's good, because that's a good point that you bring up, because we're going from 5.1 to 4.1. So even if we are getting that revision higher, we're seeing a much bigger gap between those two numbers, right? So 4.6 minus 3.9 was only 70 basis points, right? So that was only 3 cuts, but now we're getting 4 cuts from 5.1 to 4.1. So that's a very good spot. Shout out to Chirag for catching that. So that's 4 rate cuts from 5.1 to 4.1. So that's very good. And the good thing is that you guys mentioned inflation, and that is exactly it. Sanjeev mentioned doesn't include today's CPI. Exactly. So CPI came out today, and this is the first time it happened since 2017, right? So this is the first time it actually happened. I think I was reading that article that's not happened in over 8 years or something, that both the CPI and the FOMC fell on the same day. And for that reason, this number or the expectations here do not include for the better than expected CPI numbers we got today. So it's possible that this gets revised again in the next SCP, and that revision could be better. And that comes out in September. September 18th is when that date's going to be for the SCP to come out next. But that's the silver lining. Couple silver linings here to take away from it is now 4 rate cuts expected between 2024 and 2025, which even I didn't catch. So shout out to Chirag for mentioning that. And then Sanjeev mentioning, of course, today's CPI numbers not being included. Something I mentioned earlier also is that CPI 8:30 a.m. Eastern, FOMC speech at 2:30. So they don't have enough time to include that in their SEP from today. So we got better numbers. So it's possible that Jerome Powell addresses that and kind of dismisses, and the market starts to dismiss some of that upside revision that we got from today. So overall, market's starting to give back some of those gains as expected, because this is, again, 2 fewer rate cuts than what previously anticipated, and 1 fewer rate cut from the market's expectations. We'll take a look at the Fed Watch tool here in just a minute to see how the markets are reacting to the numbers that we just got. So we're going to go to current, or we're just going to type this again. So let's do this. Let's go over here and we'll take a look. This is going to take some time to kind of get adjusted. So yeah, we'll reload this in a couple minutes here, but it takes time to get adjusted here. Folks, make sure that you are dropping a like. We're over 100 likes here, with over almost 500 people watching. So make sure that you do drop a like, subscribe to the channel if you haven't already. And I'm happy to explain and go over anything in particular. If you have any questions about what we just witnessed, what were the numbers like, what really happened, why it happened, I'm happy to explain and go over that in more detail. So if you have any questions, please feel free to ask. Let's just take a look. So yeah, AI hype, inflation is improving. The economy is still too strong for CPI came in good, or too steady. So economy adapting to high rate environment. So those are all good reasons. And the reason being is because from what I believe is that the earnings are strong, the spending is strong on the back of debt, right? There's a lot of credit card debt. There's a lot of, mortgage debt, auto loans. So they're all hitting new all-time highs. And for those reasons, I think we're seeing very strong spending and earnings from companies, but that's not going to go on forever, right? We're already starting to see some of the more higher risk credit products, like just credit cards, delinquency rates are starting to increase. And that, of course, is not going to, be well, because if that is going to continue to increase, eventually it's going to ripple into some of the other parts of the market, such as mortgage rates, auto loans. They are the ones to follow in terms of delinquencies. So if the markets aren't rallying on the disappointing Fed announcement, you can be sure that Jerome Powell, JP Morgan and other banks will rally the markets using their HFT algorithm once Powell speaks. Yeah, I mean, it's possible. We're starting to see some of that momentum once again. Buyers are stepping in because there are a couple silver linings, right? It's not all bad news, even though we did get a pretty decent upside surprise. Let's also read the statement very quickly because we're going to learn more about their plans with the Treasury securities and the mortgage-backed securities as well. So the committee does not expect it will be appropriate to reduce the target range until it has greater confidence that inflation is moving sustainably towards 2%. In addition to, the committee will continue reducing holding its Treasury securities and agency debt and mortgage-backed securities. Let's just take a look. Let's see. So rollover at auction, the amount of principal payments from Federal Reserve's holdings exceeds, again, the same amount, $25 billion per month. And MBS, if it exceeds a cap of $35 billion a month. So again, they're doing about $60 billion. So that is unchanged. And of course, interest rates are unchanged as well. So the big change really came in with only one number, and that is a federal funds rate. That's exactly what we were looking forward to as well. So how many people here think the markets are actually going to be down today? So type 1, if you believe, 1, if you think markets are closing red, and 2, if markets close green, and 3, if markets close very green, meaning that after Jay Powell starts talking, we absolutely rip to the moon and we are going to just be higher than where we were before the statement. So let me know what you think, what you believe is going to happen after Jerome Powell starts talking in about 18 minutes. 18 minutes, folks. We got 18 minutes left, and we're going to take a look. So lots of ones, man. Lots of people expecting the markets to close down. Some 2s now popping up, 3s, a couple 3s. So 2s and 3s are now starting to show up, but okay. So we got, someone said 3, yeah. So 3 would be very green, meaning the markets can rip higher even further, more than before the report came out. We've got a few 3s, 2s. I feel like it's a bit of a split here. 4 is even more green, huh? More green than 3. Sprummer already says no use of all these will go up and up and up and up. Well, it's 2.5. 2.5 somewhere between 2 and 3 here. Not super green and green, but somewhat green, I guess. Okay, so we got a bit of a split, I would say. I'm seeing equal amounts of 1s as I am over 2 and 3. Yusuf said, at what point do we see the valuations in these markets are absurd and the bubble burst? So valuation are not at a level where I would consider it like bubble. Maybe there's specific pockets in the market, specific sectors and stocks that are trading in, levels or valuations that are insanely high. But on aggregate basis, the markets right now, I don't consider them to be like bubble territory or super high. Yes, there are specific metrics that you can look at, like debt to GDP, or even market valuations to GDP, that are suggesting for valuations to be very, very extreme, or the CAPE, Shiller PE ratio. So some of those things may suggest that we're overvalued. But if you just look at the more price to earnings multiples, or on an average basis, earnings yield for the S&P, the equity risk premium, especially when you consider the forward growth, then in those scenarios, the markets are expensive, but they're not overvalued to a point where it's a bubble and it needs to burst 40%, 50% for the markets to come down. However, there's been a lot of analysis, there's been a lot of research put together that, number one, with the inversion of the yield curve, the longer the yield curve is inverted, the bigger the risk and the more severe the risk for a recession for eventually to happen. And that, of course, leads to an on average 45 to 55% sell-off in the S&P 500 if the inversion of the yield curve is over how many days? If the inversion of the yield curve is over how many days is when the S&P 500 on average sees a 45 to 55% sell-off. So let me know in the live chat. I want to make this more, engaging for all of you. And in the meantime, you also, learn these interesting stats or statistics or whatnot. So let me know how many days is, if the inversion of the yield curve passes that number of days, the S&P 500 on average sees a 45 to 55% sell-off if there's a recession that follows. How many number of days? So let me know in the live chat, what is your answer for the inversion of the yield curve? And historically speaking, I think going back to as far as 1960s, when the inversion happens, how many days above, then the S&P's, on average decline 45 to 55%. So let me see who's remembered these stats here. Anyway, so QQQ is 1.3% higher still. S&P is up about 1%. Let's take a look at some individual stocks because Apple's still holding up its gains. Microsoft up over 1.6. Tesla still holding up its gains, up almost 5%. So markets overall seems to be, doing, I would say, reasonably well, especially individual stocks. They're still holding up on those gains. Nvidia is the only one that's dipped below that 4% mark. So over 90 days, 180 days, 625 days, 580 days, 90 days, 6 months to 2 years usually. So how many days is that, Yusuf? I'll let more answers come in and then we'll talk about it. But yeah, we got the FOMC meeting starting in about 14 minutes here. 14 minutes. And then we will listen in to what Jerome Powell has to say to the entire market. And what's up with all these revisions here to the upside. Powell, what's going on? So yeah, the answer is over 500 days. So over 500 days, if the inversion of the yield curve happens for more than 500 days, on average, the S&P falls about 45 to 55% if there is a recession that follows. So yes, 500 days or more is the severity of that recession, and the market sell-off significantly increases from 20-30% to over 45% in terms of that market sell-off. So 3, Imran just been typing 3, huh? So I think the market really is recovering 1.3%. 500 is nice, good info. No short until IWM 214 to 218. So IWM, I did pick up some shares today for IWM because I think, it's got small caps have potential rest of 2024, even kind of going into 2025. The reason being is because, again, interest rates eventually is expected to be lower than where it is right now. May not be tomorrow, may not be this week, may not be next month or in a few months, but eventually we are expecting for rates to come down. And of course, the small caps to do much better than large caps because they are the more interest rate sensitives compared to large cap. So now we've got a pretty split vote. 360 votes. Let's see if we can at least get up to 500 by the time Jerome Powell starts talking. So 140 votes right now for Powell's speech today. So make sure that you do participate and let us know, what are you expecting from Jerome Powell today? More hawkish or more dovish tone? So definitely do participate, and we'll end this poll about a couple minutes before Jerome Powell starts talking. So we'll have a good data set. Right now, 57% of people are expecting Powell to be dovish, despite a pretty hawkish print on the S&P. Despite a pretty hawkish print. But the good thing is we're back to before the statement release. 475 is the number we need to clear on the day in order for the markets to literally be back to where they were before the statement was released here. So that's the target to watch intraday. And then for the S&P 500, that's going to be a target of close to 543 for the SPY. So that's going to be that level that we need to break out of for both the S&P and the NASDAQ in order for us to be higher than where we were pre-report. Interesting print. It was quite a volatile few minutes there for the market, but a nice recovery, of course. And yeah, it's crazy how so much money is moved on just the words from Jay Powell. Whatever Jay Powell says, billions and hundreds of billions and trillions are moved in the market. So yeah, just for people joining us right now, no interest rate change, no cut, no hike. Interest rates remain intact at 5.25% and 5.5%. The big change happened in the S&P, which is a 50 basis point increase in interest rates in 2024. That simply means one cut priced in or penciled in from the Federal Reserve in 2024, and that is 2 fewer rate cuts compared to their projection from back in, this is a previous one, there we go, from back in March of 2024. Everything else stays the same, slight increase in inflation expectations from 2.6 to 2.8. Another thing that we didn't quite understand in the previous report, which I also mentioned, was maybe it was not the last meeting, but the meeting before that. So it wasn't the March meeting, but if you go to 2023, it was like towards the end. So if you go to December projections here, so what the Federal Reserve did here, there was one meeting where they increased their inflation expectations. There we go. It was the meeting here back in March. So it was the March meeting, not the December meeting, but the 2024 March meeting. And what they did there was they increased their inflation expectations. So you can see that this is from back in March, and the core inflation went from 2.4 to 2.6%. And they kept the interest rate expectations unchanged and the same. So that was actually quite interesting. And I think one of the first questions, I remember talking about this, one of the first questions was going to be about this very fact. And it was asked that why did you keep interest rate expectations unchanged even if you're raising expectations for inflation to go up from 2.4 to 2.6% in 2024. And I think Jerome Powell, once again, he's the king of vagueness, did not have a very specific answer. He's kind of beating around the bush. And again, the follow-up question was also very similar, to which also he did not give a very clear answer. So we kind of were left confused at that time. Why did the FOMC raise inflation expectations while keeping interest rate expectations unchanged? And this meeting, what they've done is they have, again, increased both, but they've done it at a very different magnitude. So it kind of makes you wonder sometimes, like, what really is going on with the FOMC, with the 19 members that are part of the committee, and what are they discussing really? Because in some meetings, they raise inflation expectations, keep interest rates unchanged. Some meetings, they increase inflation from 2.6 to 2.8. You can see the last couple of meetings have really just been increasing inflation expectations. They've gone from 2.4 to 2.6, and now they've gone from 2.6 to 2.8. So it would have been much better to have gone from 4.6 to 4.7, 4.8 in the March meetings. So instead of keeping this unchanged, they should have really just increased it with the same order of magnitude as they're expecting inflation to go up. But instead, they did, 20 basis point increase in inflation over 2 reports, so 2020. And then they just did a one mega increase of 50 basis points in one report for interest rates. Would have been much better and much less severe had they done this 4.6 to go up to 4.8 as inflation expectations go up. And then for this number to also go up from 4.8 to 5.1 as inflation expectations go up. That would have been much better steady increase than just changing inflation over 2 reports and changing interest rates over 1 report. But anyway, so markets here, again, we're just consolidating at the moment. We did drop, then we got bought back up. And the markets are really going to be waiting for Jerome Powell in about 6 minutes here. Wow, we're over 400 votes now. Let's see if we can hit 500. 500 votes. If you haven't voted already, make sure that you do vote. We only got 94 votes until 6 minutes. So make sure that you participate. Make it happen, guys. Make it happen. 500 votes is what we're looking for. Are you expecting the speech from Jerome Powell and Jerome Powell himself to be hawkish or dovish? Hawkish or dovish. So make sure that you do participate. Only 91 votes to go. 91 votes to go. Let's do this. We are 6 minutes away from Jerome Powell. What color tie? What color tie, Kevin? What color tie is he wearing? We've got purple. We got blue. We got red. I don't think he's ever worn red. I don't think he's ever worn blue because they can be more political. I think he's mostly ever worn purple. I think purple is going to be the tie today, but we'll find out. But most of the times he's worn purple because that's a more, well, it's a shade of blue, I would say, or it's a shade of red, but it's mostly been purple. So rainbow color, blue, red. Now I've never seen a Jerome Powell with a with a red or a blue tie, I guess. Maybe he used to wear it, but it's mostly been with purple. Srinivas, hi Caddy, how are you doing? When is your marriage? Not anytime soon, not in the next couple of years at least, but yeah, we'll see. Green, I don't think he's ever worn green either. But we're going to do an audio check. We got 4 more minutes. We're up to 423 votes. We got, again, 77 votes left. So make sure that you do participate and get that number up to 500. If you haven't already, vote, vote, vote. And also do vote for Tesla here as well. Tomorrow's the big meeting, shareholder meeting. If you haven't voted, if you're a Tesla shareholder, you should participate in that vote. Every vote counts. Srinivas, yellow. Okay, so we're going to do an audio check just to make sure everything is working well. And we should be all set with the live stream. I'm going to grab a pen and a paper. So I'm going to do an audio check. Just let me know in the live chat if everything is good. Hopefully if everything is audio video is good. And I'm going to put the S&P 500 here at the bottom right. We got the NASDAQ up top and the 10-year yield is behind me. And then of course we've got, the Federal Reserve's meeting and Jerome Powell's speech right over here. All right, we are ready. This is it. This is it. We're at 434 votes. 2 more minutes left. And let's do this. Who is ready? So we got 54% dovish, 46% hawkish. So it is a pre-split vote. And let's do this. This is the big moment. Let me just grab a pen and a paper here. We are ready. We're ready for the big Fed meeting here. So a couple more minutes, about 1:30 left. And then we'll do an audio check as soon as this thing goes live. So market's almost back up to its pre-SEP high of 475 here. And big tech is going to be to the right of my screen over here. So you can see Amazon, Netflix, Meta, Google, AMD, Microsoft. Tesla's up almost 6% now. Apple up almost 6% as well. Nvidia up close to 4%. Microsoft, AMD also. Microsoft's hitting a new all-time high at almost 440. Meta flat, Google's up over 27 basis points. Amazon, Netflix are the only 2 big FANG stocks that are selling off here on the day. And Meta's slightly flat here, slightly down on the day as well. And then, of course, we got GME down a little bit, over 6% to $28. PayPal's down over 2%, so not participating in this party right now. But yeah, here we go. So just let me know in the chat if the audio is good, okay? Please make sure that you let me know so that we don't have any technical difficulties. As soon as he comes, I'm going to turn on the audio, and then you all let me know if everything is good.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamarosa of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings like the one that we saw this morning make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the dot plot, their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls, but we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Janelle.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So, by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, you know, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and you know that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So you really, if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces. And there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate. And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Stein with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy rate now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had, above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. to some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters. And I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. Where people experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It's just going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. We remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as a spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria. Hi, Victoria Guido with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just tell we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I can think of things that many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not. It's the whole. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has been, has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability. And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing. And all the other details, we don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't, there isn't any one thing, one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
All right, everyone. So that was quite, I would say, an okay meeting. Here, let me just do that. I'm not sure what's going on with my MacBook because I'm not able to quit out of this. But anyway, so markets hitting a new all-time high. We got the Nasdaq now up over 1.7%, 476, a new all-time high. The S&P up over 1.2%. I got my whole notes that I need to summarize. So I, obviously was listening to a lot of what the Federal Reserve, Chairman Jerome Powell said, but at the same time, a lot of that was like kind of repetitive, something that we've already learned. We've not gained the greater confidence. I mean, economic growth is still strong and resilient, and labor market's coming back to equilibrium. The federal funds rate, he said that it won't be appropriate to reduce rate until we get that greater confidence. Most of the members agree that I think they're going to be data dependent and they're not very decisive with where they are with interest rate expectations. So again, lots of the same stuff, but I'm going to be doing a separate, more dedicated video kind of summarizing everything that was discussed. And the markets here now are starting to roll over a little bit quite aggressively. We're seeing the Nasdaq and the S&P come back down here with, of course, individual stock-wise, everything is up, but it's now starting to somewhat roll over as soon as Jerome Powell's speech was ended. Whew! This could be a bit of a rug pull here. The last couple candles, okay, so there is some selling pressure coming in from the markets here with volumes also starting to increase at the moment. So we did hit a new all-time high at 476. And I'm just going to wait a couple of minutes here to see what this pullback is going to be like, because it does seem pretty aggressive last couple minutes here from the markets selling off, as soon as the meeting ended, about 30 basis point lower in just about 2 minutes for both the S&P and the Nasdaq. So hope you all enjoy this video. And again, so we are seeing a bit of a sell-off here. Quite an interesting sell-off that's taking place. So again, I'm going to be live just a couple more minutes here. I do also want to mention that our MoneyVest platform is getting ready for the beta launch. So if you are watching this live stream, if you are currently with us, you can get access to all of this, research and this analysis. So if you want to use this platform where you can, again, do a full fundamental analysis with a lot of really interesting charts and visually, look at different stuff. For example, right now I am on Tesla, I'm looking at revenue, operating income, net income. You can visualize these, including our MoneyVest metrics, as well as our fundamental analysis, analyst estimates, including, the different financial statements. We're going to be adding more functionality, more features, more tools over time, as well as our discounted cash flow, discounted earnings multiple model. All that stuff is going to be included. If you want to check that out, link's going to be down below. Right now, we're offering a 51% discount for anybody who signs up before the beta launch on July 8th. So again, feel free to take advantage of that. After that, of course, that pricing is going to go up, so you can lock that in for life if you want to take advantage of that. So link's going to be down below. Markets definitely do 3 minutes here of selling pressure, and we are continuing to see that, folks. What is going on? 5 minutes. This candle has definitely been quite aggressive, with the markets really starting to roll over right now. So this has been a bit of a steeper sell-off right after the Federal Reserve ended their meeting. So anyway, so thank you so much for joining, everyone. Really appreciate it. And again, link's going to be down below if you want to join early access to the launch that's going to happen on July 8th. And again, you can lock this pricing in for 51% discount at the moment. So limited spots left for a limited time. Link's going to be down below. This seems to be a bit of a rug pull that's happening in real time right now with the NASDAQ here dropping. Last couple candles here down about 0.5%. And the S&P 500, same story. I mean, just look at that drop here. After Jerome Powell's speech here, just ended, 41 basis points. Last 30 minutes, yeah, hedge funds are going to do what they do best. We're seeing a bigger sell-off right now. So, again, thank you so much for joining. Happy investing. Take advantage of the discounts down below with the link in the description. I'll see you all.